Navigating portfolio building. Balancing U.S. versus international exposure across investor profiles. Constructing a robust investment portfolio involves considering the balance between U.S. and international exposure. This allocation decision is critical for achieving diversification, managing risk, and capitalizing on global market opportunities. Whether you are a new investor, seasoned strategist, aiming for early retirement, or nearing retirement age, understanding the nuances of U.S. versus international exposure is essential. In this article, we explore the basics of portfolio building and how it differs across various investor profiles. 1. Basics of portfolio building. U.S. versus international exposure. Portfolio building involves strategically allocating assets across various markets to achieve a balanced and diversified investment mix. U.S. exposure typically includes investments in U.S. stocks, bonds, and real estate, while international exposure encompasses investments in foreign markets, such as developed and emerging economies. Having exposure to different markets allows you a. benefit when one market is doing particularly well and b. make up for your other market if it is doing poorly at that moment in time. Essentially, this is touching on the concept of diversification of assets, which aids in lowering the risk typically experienced when putting all of your investment resources into a single form of investment or market. 2. Different strategies for each investor profile. A. New investors. Strategy. Start with U.S. exposure. New investors often begin with a focus on U.S. exposure due to familiarity and confidence in the domestic market. They can initially allocate a higher proportion of their portfolio to U.S. stocks and gradually introduce international exposure as they gain experience and confidence in global markets. B. Experienced investors. Strategy. Optimize diversification. Experienced investors recognize the importance of diversification and may seek to optimize their portfolio by balancing U.S. and international exposure. They understand that international markets offer unique growth opportunities and may allocate a significant portion of their portfolio to global equities and diversified international funds. C. Investors aiming for early retirement. Strategy. Embrace global growth potential. Investors aiming for early retirement often have a longer time horizon and can benefit from the growth potential of international markets. They may prioritize higher allocations to international equities, particularly in emerging markets, to capitalize on rapid economic expansion and diversify their portfolio away from U.S.-centric risks. D. Investors nearing retirement. Strategy. Prioritize stability and income. Investors nearing retirement tend to prioritize stability and income generation. They may maintain a more conservative approach with a higher allocation to U.S. assets, such as blue-chip stocks and investment-grade bonds, to mitigate volatility and ensure steady income streams during retirement. 3. Considerations for each investor profile. A. Risk tolerance. New investors may have a lower risk tolerance and may initially prefer U.S. exposure. Experienced investors may have a higher risk tolerance and can diversify their portfolio with significant international exposure. B. Time horizon. Longer time horizons allow for greater exposure to international markets to capture long-term growth opportunities. Investors nearing retirement may prefer a more conservative approach with a higher allocation to U.S. assets to protect capital and generate income. C. Financial goals. Each investor's financial goals, such as wealth accumulation, income generation, or capital preservation, will influence their allocation between U.S. and international exposure. Conclusion. Building a well-balanced investment portfolio involves carefully considering the balance between U.S. and international exposure. Whether you are a new investor, experienced strategist, aiming for early retirement, or nearing retirement age, understanding how to navigate this balance is crucial. By tailoring your portfolio allocation to your investor profile, risk tolerance, time horizon, and financial goals, you can construct a resilient and diversified portfolio that maximizes opportunities while managing risks. Seeking professional guidance and periodically reviewing your portfolio allocation is recommended to ensure it remains aligned with your changing financial needs and market conditions.